Your credit score isn't magic, it's math. And once we learn the 5 things that go into your credit score, now you can play to win and we can get you to level up. There is a formula behind FICO and it's not even a mystery. It's just a system that a company created to predict if you're gonna pay your bills or not. Understand it? And sometimes you can even outsmart it. We can't let the machines take over, can we? Let's get after the first biggest part of FICO, and that is your pay history. Pay history accounts for 35% of your credit score. When I'm talking about pay history, that goes for your credit cards, your car loans, your auto loans, even your collections if you have any of those. But what's not in that pay history, oftentimes people think, well, I'm paying for my cell phone, or I'm paying for my insurance, I'm paying my rent, I'm paying whatever. Those will not report to your credit. Anytime you apply for something using your social security number, typically that's going to report to the credit when you're, again, asking for money. When you apply at a cell phone carrier, they're running your credit to make sure you're not one of those people that jumps from cell phone carrier to cell phone carrier to cell phone carrier, and that goes for usually electric, gas, cable, internet, all that stuff. When you want money, so when you apply for a credit card, a car loan, student loan, personal loan, all that factors into your pay history. The more negative and derogatory that's in your pay history, the worse it's gonna be. In the inverse, if you don't have any pay history whatsoever, that's 35%. No pay history there, bad. So we gotta get pay history if we don't have any. The next 30%, that's right, it is the second biggest piece of the FICO puzzle, is your debt and utilization ratio. Oftentimes people will be out there on the internet saying it's only your credit cards. Nonsense, it's all your debts that are in that 30% and how you're managing them. Can you manipulate your FICO score a lot easier with credit cards? Absolutely. Typically because that's much smaller debt to be able to pay them down to make your scores go up. But you can pay an installment loan off, and that can also cause your credit scores to go up. But usually an installment loan is like 10 or 20 grand. It's a car loan, right? And it doesn't impact as much if you have higher credit card balances. So when we look at our debts and utilization, them collections too, by the way, are they paid off? If they're not, that really impacts hard into that 30%. So those two things alone, pay history, debt, and utilization, are a combined 65% of your score. The age of your credit, meaning how long have you been around with credit, accounts for about 15% of your score. I get a question a lot like, oh, I closed an old credit card and it dropped my score. Yeah, probably because you don't have anything in its place, meaning you had a credit card that was 4 years old, then you got a new credit card 6 months ago and canceled that old credit card. So you got hit twice because you got rid of all that great credit history in one fell swoop and you limited or shortened your available credit as well. That's why when people close accounts and they see their credit score drop, that's why. You eliminated a card with a lot of good history on it and you decreased your overall credit usage. The next 10% is credit mix. It's not really like we're making a mojito. I know it's summer, sounds pretty good, but it's installment and revolving accounts. So credit cards, car loans, mortgages, student loans, all that kind of stuff, it accounts for 10%. The last 10%, which I used to break up into 2, is gonna be your new credit and inquiries. Inquiries, I will cover more in depth on a bonus video or something because not everybody cares or they think they got it. But understand that inquiries, hard inquiries, will negatively affect your credit, and your new credit that you have, oftentimes people will see scores drop when they get new credit. Well, it's a new debt without a lot of pay history on that new account. Once you roll 3-4 months of good on-time payments with that new debt, scores kind of climb back up. In the next video, we're gonna talk some strategy. Yeah, we know the 5 factors, but how do we manipulate our credit to jump our scores and jump them fast? That's what we're gonna cover in the next video.